Nobody warned you. That is the part I want you to sit with before I say anything else. Nobody warned you in 1929. Nobody warned you in 2008. Not the newspapers, not the banks, not the government, not the television anchors with their confident voices and their expensive suits. The warning was there. It was right there, in the mathematics, in the bond market, printed in numbers that any disciplined person could read. But nobody translated it for the ordinary man sitting at his kitchen table, wondering why his savings felt smaller every year. I spent 7 decades studying how wealth is built and how wealth is destroyed. And I have learned that the most expensive disasters in financial history were not surprises. They were ignored warnings. There is one warning that has appeared before every single major economic collapse of the last 100 years. It appeared in 1928. It appeared in 2000. It appeared in 2006. And what most people do not know, what nobody on television is saying clearly and directly, is that this same warning just completed the longest, most extreme signal it has ever produced in recorded American financial history. Longer than 1929, longer than 2008. I call this the signal nobody translated. And today, I am going to translate it for you. I want to start the way a teacher starts, not with fear, not with predictions, with a simple question that unlocks everything. What does it mean when the people who understand money the most, not retail investors, not day traders, not the optimists on financial television, but the bond market, the most cautious, most conservative, most data-driven corner of the entire financial world? What does it mean when those people start behaving as if tomorrow is more dangerous than the next 10 years? That question is the entire story, because that is exactly what a yield curve inversion means. And it is the most important thing I am going to teach you today. Let me explain it the way I would explain it to my grandchildren. When you lend money to someone, you expect to be paid more for lending it longer. If you lend a friend $10 for 1 week, you charge him a small fee. If you lend him $10 for 10 years, you charge him much more, because 10 years is uncertain, risky, and far away. That is the normal shape of the financial world. Short loans cost less. Long loans cost more. The yield curve, which measures the interest rates on United States government bonds across different time periods, normally slopes upward for exactly this reason. But occasionally, rarely, and only under very specific and very dangerous conditions, that curve flips. Short-term rates rise above long-term rates. Suddenly, it costs more to borrow for 6 months than for 10 years. And when that happens, it means something profound and terrifying. It means the bond market, the smartest, most cautious money in the world, is more afraid of right now than it is of a decade from now. It means the people who lend trillions of dollars for a living believe that something in the immediate future is so dangerous, so uncertain, so structurally broken, that they would rather lock their money away for 10 years than risk it for 6 months. That is not a minor technical anomaly. That is the financial system's nervous system sending a distress signal. Now let me show you why this particular moment in 2026 is unlike any other. In 1928, the yield curve inverted. People ignored it. The stock market continued rising for nearly 2 years after that inversion. The headline said, "Permanent prosperity." The book said, "A new era." The investors said, "This time is different." Then in October 1929, the dream ended. The Dow Jones Industrial Average lost 89% of its value between 1929 and 1932. 89%. An entire generation of American families lost their savings, their farms, their businesses, and their futures, because they confused the delay of the consequence with the absence of the consequence. In 2000, the yield curve inverted again. Months later, the dot-com bubble collapsed. The Nasdaq lost 78% of its value over 2 years. In 2006, the curve inverted once more. The housing market looked strong. Unemployment was low. Stocks were hitting new highs. People said the inversion had failed because nothing had happened immediately. Then 2008 arrived. Banks collapsed. Trillions of dollars evaporated. Families lost their homes. And that same line on that same chart had warned every single one of them, 18 months in advance, with mathematical precision. But here is what I want you to understand about the current moment. The inversion that began in July 2022 was not merely another data point in a historical series. It was, and I want you to hear this clearly, the longest yield curve inversion in recorded American financial history, over 700 consecutive days. This is only the fourth time in the past 100 years that a yield curve inversion lasted more than 500 days. The first three times were 1929, 1973, and 2006. Every single one of those ended in catastrophic economic destruction. In 1929, the Dow Jones fell 89% and did not recover for 25 years. In 1973, the S&P 500 fell nearly 50% as the oil crisis shattered a generation of middle-class savers. In 2008, the global financial system came within hours of total collapse. Those are not recessions. Those are civilizational events. And now we have just completed the longest inversion of all four, longer than any of them, and the curve has begun to uninvert. Most people think uninversion means the danger has passed. It does not. It means the danger has arrived. I need you to understand this distinction because it is the most misunderstood part of the entire story. I call it the uninversion trap. In both 2000 and 2007, the yield curve briefly reinverted before uninverting permanently. And in both cases, the moment of uninversion, the moment when short-term rates dropped back below long-term rates, was not the all-clear signal. It was the starting gun. In November 2000, the curve uninverted. The dot-com crash followed within months. In May 2007, the curve uninverted. Lehman Brothers collapsed 16 months later. Right now, in early 2026, the curve has uninverted into what economists call a bear steepening phase, where long-term yields rise faster than short-term yields. Research from the Federal Reserve and multiple academic institutions has identified bear steepening as a precursor to reduced industrial output and weakening labor demand. It is the financial system shifting from warning mode into collapse mode. The warning period is ending. What follows the warning is the event itself. Now, I want to show you something that makes this cycle more dangerous than any of the three that came before it. I call it the debt multiplier. In 1929, American household debt was manageable relative to the size of the economy. In 2008, the debt was concentrated primarily in housing, catastrophic, but localized to a single asset class. Today, the debt is everywhere simultaneously. Mortgages, student loans, auto loans, credit cards currently at record high balances, with delinquency rates rising at their fastest pace since 2010. Corporate debt that must be refinanced at interest rates double what those companies originally borrowed at. And United States government debt that now requires more than $1 trillion annually just to service the interest. A number that grows larger every single month, regardless of what any politician promises to do about it. A family that borrows too much eventually has to stop spending. A business that refinances at double its original rate eventually has to eliminate workers. A government that owes more than it can sustainably collect in taxes eventually faces a choice between printing money or default. These are not political opinions. They are arithmetic. And what the yield curve has been telling us for over 700 days is that the arithmetic is reaching its limit. There is one more mechanism I want you to understand before I tell you what this means for you personally. I call it the cushion illusion. When the yield curve first inverted in 2022, many economists predicted an immediate recession. It did not come. And people took that delay as proof that the signal had broken, that this time was genuinely different, that the modern economy had become recession-proof. What actually happened is more sobering. American consumers entered 2022 with more than $2.5 trillion in excess savings accumulated during the pandemic. That extraordinary cushion absorbed the shock of rising interest rates. People kept spending, businesses kept hiring, and the surface of the economy looked healthy, while the foundation beneath it was being systematically undermined. But that cushion is now gone. The excess savings have been depleted. Credit card balances have replaced the stimulus checks. Consumer delinquencies are rising. Full-time employment is quietly shrinking, while part-time employment and multiple job workers increase, a pattern that appeared in the data before every major recession of the past 50 years. The armor that protected the economy from the 2022 inversion no longer exists. What protected us from feeling the damage then is precisely what makes us more vulnerable to feeling it now. I know what some of you are thinking. You are thinking, Warren, if this is so obvious, why is the stock market not already collapsing? Why are we not already in a recession? You are asking exactly the right question. And the answer is both simple and deeply unsettling. The delay between a yield curve inversion and the economic consequence has never been immediate. In 1928, stocks rose for almost 2 more years after the inversion. In 2006, the market hit new all-time highs, even as the inversion deepened and the housing cracks widened. The delay does not disprove the signal. The delay is part of the trap. Because the longer the delay, the more confidence builds, the more people borrow, the more leverage accumulates, and the more catastrophic the eventual correction becomes. Right now, with the 10-year Treasury yielding 4.38% and the 2-year at 3.90%, the curve is technically positive again. The surface says calm. The foundation says otherwise. And I have lived long enough to know that the calm before a financial storm is not a gift. It is a final opportunity. The question is not whether you feel the urgency. The question is whether you use the time. Let me end with the thing that matters most. Not the charts, not the data, not the historical parallels. The thing that matters most is what you do with what you now know. I am not telling you to sell everything. I am not predicting a specific date or a specific number. I am doing what I have always done, reading the architecture of a system and telling you honestly whether the structure is sound. And right now, the structure of the global financial system is carrying more debt, more leverage, more concentrated risk, and more historical warning signals than it has at any previous point in my lifetime. The bond market, the most conservative, most cautious institution in the history of modern finance, spent 700 consecutive days telling us it was afraid. That is not noise. That is the most expensive signal in the world, screaming at a volume that only the disciplined can hear. I have sat across tables with some of the most brilliant minds of the 20th century. I have watched Nobel Prize winners make catastrophic financial mistakes. I have watched ordinary people with nothing but discipline and patience build extraordinary security. The difference was never intelligence. The difference was always the willingness to hear an uncomfortable truth and act on it before everyone else did. I want you to imagine yourself 10 years from now. You are sitting somewhere quiet, looking back at this exact moment, March 2026, when the longest yield curve inversion in recorded American history had just ended, when the uninversion signal that preceded the 2000 collapse and the 2008 collapse had just appeared again, when every historical parallel pointed in the same direction, and when the surface of the market still looked calm enough to ignore it all. What will you tell yourself? Will you say that you saw the signal and used the time wisely? Or will you say that you knew, that it was right there in front of you, that history was spelling it out in the clearest language it has ever used, and you chose the comfort of the music over the honesty of the math? I cannot buy back the years I spent learning these lessons the hard way. I cannot undo the losses of the people who ignored the warnings of 1929 and 2008. But I can stand here, right now, in this moment, and tell you that the yield curve does not lie. It has never lied. And the message it has just finished delivering, after 700 days, the longest message of its kind in history, is not subtle. It is not ambiguous. It is not a prediction. It is a record of what has already happened inside the financial system, written in the language of mathematics, waiting for the physical world to catch up. The door to the cage is open. It has always been open. The cage is not poverty or circumstance. The cage is the decision to believe that because the storm has not arrived yet, the warning was wrong. History has never once honored that belief. Not in 1929, not in 2008, and not now. You have today. You have right now. Prepare not with fear, but with the quiet, unhurried discipline of someone who has read the signal, understood what it means, and decided to act before the music stops. That is all. Thanks for watching.